Hi, and welcome back to Channel 11 News. Today is Tuesday, August 2nd. It's been a crazy first half of the year. One of the craziest parts of the market being obviously the cryptocurrency market. Today, I'm very delighted to have a special guest with us, Hunter Horsley, CEO of Bitwise, one of the largest and most active investment managers in the crypto space. Hunter, thanks for joining us.
Absolutely, Ken. It's fantastic to be with you, and always fun to talk about the craziness in crypto land.
Before we get started, can you tell the audience a little bit about yourself and how you got into the cryptocurrency markets and what led you to start Bitwise and what you guys do?
Sure. Yeah, absolutely. So crypto has sort of pulled in people of a lot of different walks. There's a community coming in from Wall Street and traditional financial services. There's a tech community. There's some people who are in it for philosophical reasons. My background is on the tech side. So once upon a time went to the Wharton School, but most previously had been a product manager building software products at Instagram. Was there from 70 million to $1 billion in revenue, and then at Facebook. And like many people in tech, saw what looked like the glimmer of the next computing platform, and we can talk more about that in blockchains and the crypto space, and was incredibly excited about it. Now today, what we're doing is it couldn't seem more unrelated than Facebook or Instagram. But the firm that we've assembled here has tried to bridge the disciplines of native understanding of tech, since the asset class is ultimately open source software that we're investing in and navigating, and it's developers that we're thinking of as driving the value. And we've married that with individuals with decades of experience in asset management and capital markets. So the firm today, 75 people. We're the largest crypto index fund manager in the US, one of the largest crypto asset managers. We just do crypto, and we work with financial advisors, RIAs, institutional investors, high net worth individuals across the country, have relationship managers across the country, and an expanding set of solutions for investors to be able to access whatever part of the evolving opportunity set suits them, but mostly to be the relationship that they can get answers and partnership from in navigating the space. So that's a little bit about Bitwise.
That's great. And maybe before we kind of jump into what's going on in the markets, because I know it's top of mind for everyone, for those that may not be as familiar with the crypto kind of universe, a lot of people just think about it as, okay, here's Bitcoin. It's a digital gold. It's a place to just park my money. But there's a lot of technological use that cryptocurrencies and coins have. Can you maybe get like a simple way that you think about it to describe it to some people that aren't as familiar with the market?
Yeah, absolutely. I mentioned before that crypto is pulling in a lot of different communities, and I sometimes think it's a little bit like this prism, and depending on which lens you look from, you see a different color bouncing out of the prism. So individuals who are coming from financial markets and capital markets and financial services often see a new asset class, digital gold, a new alternatives asset class, maybe a new form of payment or FX, and that is often the lens. And we think of it as currency, and will it compete with the dollar, and those types of considerations. Then there's the community that looks at it from the technology lens, and there you hear people saying things like a new computing platform or the next wave of innovation, and they're often thinking about it in the way that people thought about mobile or cloud or SaaS, where there's some new breakthrough in what's possible, and now applications need to be developed and new opportunities will emerge. And then there's a third community that's less often sort of focused on, which is sort of the philosophical community that says, we've lost trust in corporations over the years to big tech selling our data. And we've also lost trust in government or the public education system. So there's this trend around declining trust in sort of central authorities, and And so some people come to crypto with that lens, and they talk about things like self-sovereignty and controlling your assets. And so it really depends on which constituent you are and which constituent you're talking to. And I think it's one of the reasons the space can be so confusing. We're all sort of talking about the same thing, but with a lot of different language. And again, that's why I think it ends up sometimes feeling so different depending on who you're talking to. The lens that I honestly find the most helpful for thinking about the space is to think about it through the more tech lens. And so there, what I would, if I just give me 90 seconds on it, I don't want to put anyone to sleep with this. But the way I would think about it as a mental model for understanding all the craziness, thousands of coins, all the different things we see, and we wonder, why is this happening? What should we expect from it? The analogy that I think is very helpful for thinking about the space is to think about the iPhone and to think about it as a new computing platform. So computing platform, not a term that we're all using in day-to-day conversation very frequently, but something we're all familiar with. Everyone remembers when the PC came out in the 90s, and then the World Wide Web, and then people remember the cloud, of course, and the smartphone. So if we look at the journey of the smartphone, 2007, the iPhone comes out. Steve Jobs goes on stage and says, it's a phone, it's a music player, it's an internet browser. It's a phone, it's a music player, it's an internet browser, and gives a famous presentation. And that year, they sell, I think, 4 million handsets. A far cry from a world-changing disruption to sell 4 million handsets in 2007. But then it goes to 5 or 7, 9, 11, 18, 25. And fast forward today, we obviously have 1 billion iPhones and 3 billion smartphones around the world. The reason I frame that up, when the iPhone first came out, it had certain capabilities. So for instance, compared to the laptop, it had a GPS. Compared to the laptop, you could bring it with you wherever you went. Compared to the laptop, it had a camera built in. Now, of course, compared to the laptop, it also had a smaller screen, and the keyboard was not nearly as good. I remember that was my gripe. Did you have a BlackBerry at the time, Ken?
Oh yeah, a lot of finance people had BlackBerries, and we were like the last to transfer over. Can't type as fast on the iPhone, right?
That's right. Goldman didn't allow iPhones at work until 2016. So almost 10 years after it came out. But yeah, I had my BlackBerry, and I remember the iPhone came out, and I said, Steve Jobs is so arrogant. He's invented a phone that nobody needs with no keyboard. This is ridiculous. But when the iPhone came out, it had these new capabilities. And what happened at that moment, you have sort of this new computing platform, and developers rush in and they start imagining everything, under the sun. So we get some reimaginations. We used to use MapQuest on the old platform, which was the laptop, and we get Google Maps. And Google Maps is taking advantage of the GPS that is new to the platform of the iPhone. And it's taking advantage of the fact that it comes with you. And we get Uber, which really was not possible before the iPhone. And that's in transportation. And then in media, we get Snapchat and Instagram. That requires the camera. It would be a funny thing to take your laptop to to a national park and be snapping photos with your laptop, but possible because of the camera on the device. We get some things in commerce. We get Venmo and Apple Pay and PayPal, so the ability to transact, and that's taking advantage of a few different things. And then we get some things that are not revolutionary, but just another option, right? You can do email on the new platform on your smartphone. And then there's some things that are just much worse. I still do spreadsheets on a desktop, on a laptop, PowerPoints, most of my email, travel booking. So it's not the case that the smartphone sort of took everything from the old platform, but it did make some new things possible, and it sort of reimagined some things that were widely used. And to get to that, developers tried every idea under the sun. So in the iPhone App Store today, there are 3 million apps, and you and I probably use, maybe have 40 or 50 downloaded, and I probably use 12 or 15 on a regular basis. So what does this have to do with thinking about crypto? And I'll get to the end of trying to sort of share my mental model for it. public blockchains, which were first pioneered by the Bitcoin blockchain, sort of introduced some new capabilities in the same way the iPhone introduced the new capabilities of the camera and the GPS. They're not better at everything in the world in the same way that the iPhone was not better about having a keyboard, but there's some new capabilities. And so what you're seeing in the space is now that the capabilities have been sort of proven out, you have the developers rushing in and building everything they can imagine. And this is why you have 10,000 coins. It's the same reason you have 3 million apps, which is the barrier to trying something new is not high, and most things won't work, but everything is going to be tried. And so that's what's taking place in the crypto space, which is people are now trying so many different things. And in this mental model that is hopefully somewhat helpful, and nothing is perfect, but hopefully somewhat helpful for understanding what we're seeing. Another component of it that you can take is that the smartphone was not for just one sector or one vertical or one industry. It's a general platform. And in the same way you had transportation and you had commerce and you had media and entertainment, in crypto or Web3, which some people are saying maybe that's a better way of describing all of this, you have a few things going on. You have financial services projects, which the industry is calling DeFi. You have things in entertainment, which the industry is now calling metaverse. You have things around property ownership, which the industry is calling NFTs or art or luxury. And you have a few different categories emerging there. And then you have operating systems, which it gets a little bit wonkier. But so I think that you'll continue to see developers trying to take advantage of these new capabilities, failing on most things, but bearing out a few things that are really useful. And we'll have to see which categories end up being the most useful categories and which projects really stick. But that's how I expect to play out. And I'll also say we got started at Bitwise in 2017, which is half a decade ago now. I had substantially less gray hair. Crypto, as you can imagine, is an unwieldy dance partner for 5 years. And we navigated through all of it. But the other thing I just add is that most of what I just described, didn't exist when I got involved in the space. It was Bitcoin, and there was this idea about a thing called Ethereum that had some extra capabilities. So NFTs, DeFi, metaverse, those are all new phenomenons emerging, and I expect that there will continue to be new things that develop in the space because it is so early in its life cycle. When people first encountered the web in the 90s, you thought about putting the newspaper on the web, or someone's university department website. People definitely weren't thinking about Snapchat in the 90s. So they weren't thinking about Kayak. And similarly, I think with crypto, there's a journey ahead here, which is part of what makes it have a lot of opportunity, and also part of it makes it so difficult to follow. But that's my mental model for thinking about the space.
That was really helpful. I've never heard it explained like that, so I think that's a great way to think about it. And I'll just share my I guess story about the utilization of it, how it relates to finance. Certain parts of the finance market, I trade and invest in mortgages, and the mortgage market, the way mortgages are made and are bought and are traded, and like the actual each person's mortgage. It is so archaic. It's like we're living back in the 80s. Like when you buy a house and you get your mortgage, somebody comes to you with physical paperwork. You got to sign like 30 different pages. That paperwork goes in a manila folder. It goes into a banker's box, and then it's held at a fireproof safe somewhere. So if I buy a mortgage-backed security, or if I buy mortgage loans to make a mortgage-backed security, I literally have to pay somebody to go get the banker's boxes, bring them onto a table, look through them, and I pay them loan by loan by loan to tell me, oh, is the title there? Is the signature there? Is this loan compliant with regulatory compliance? And there's some companies out there that are trying to take that and make it digital, because why can't all that be recorded on a blockchain? So the next time I buy a loan, I don't need to go look for the paperwork. It's all there digitally. And that's kind of one example. And that could save, it'll kill a bunch of jobs, but it could save millions of dollars in time. right? And that's one, at least how it affects my life as investing in mortgages. It's just one example of the, probably like millions and millions of ways that it could improve different processes out there. I mean, imagine if the DMV was on blockchain, right? Like all the records of the DMV. I'll give it like 40 years till we get there, but that's right. Well, okay, so we talked about the different ways to think about crypto and blockchain and all the different uses of it, and it's very exciting. What most people in the financial markets are looking at it for is making money. And people made a lot of money, and then they lost a lot of money recently. So there's been a lot of volatility. Kind of like, what's your take on what's been happening out there?
Yeah, absolutely, absolutely. So I think that the first half of this year has been a story in two parts. The first quarter of the year, and this slide shows the second quarter, and I'll voice through this, but the first quarter of this year, the story of crypto was mostly the story of macro, which was a regime change, the first rate hike in February, and liquidity is getting pulled out of every liquid asset class. And so AGG's down, values down, small caps are down, large caps are down, the Qs are down, and crypto was down too. And so that was the story in the first quarter. I think the second quarter is the one that's more interesting. The first quarter is almost remarkable that crypto wasn't down more. The second quarter, which is what this slide speaks to, is what I would call the crypto credit crisis of 2022, which has been just a mess and a self-inflicted wound on the space. But what you can see here is the journey through the end of from March 31st to June 30th, and you can see the Bitwise 10, which is our large cap index of the 10 largest cryptocurrencies. You could think of it as an S&P for the space, has Bitcoin, Ethereum, the other large ones, down 62% in Q2. The DeFi index down 66%. That's the one in the green. We then have an index of crypto companies, publicly traded crypto companies, and that was down 67%, and NFTs were down 74%. So, anyways, the story is clear, which is that Q2 was a brutal quarter in the crypto space, and June was actually the worst the worst month in Bitcoin's history, in its entire history. Wow. June of 2022 was the worst month for Bitcoin. It was down about 39% or something along those lines. So the story of the first half of the year, and we'll dive a little bit more into Q2, but the first half of the year is, liquidity is being pulled out of all asset classes, crypto too in Q1, and then in Q2, something important happened in the crypto space that was specific to the crypto space. And I'll walk through that a little bit in this other slide. And I just wanted to share these two slides. There's a ton going on here. I'll walk through this, but I'll start by saying we had long-term capital management and Lehman and Archegos all in one quarter in the crypto space, which, as you can imagine, further progressed the transition from brown to gray in my hair.
And you didn't have the Fed there to bail you out.
That's right. Yeah. Fed. Few things the Fed is less interested in bailing out than the crypto space. So what you see on a timeline here is sort of an overview of the series of events that led to the performance we talked about and leads us to call it the crypto credit crisis in Q2. So just to walk through these, May 7, you get the collapse of this thing called a stablecoin. And it wasn't the most popular one. It wasn't the second most popular one, but it was a very unique one called Luna or Terra, is two different ways people refer to it. And the punchline is that it went from $13 billion of market cap to zero in about 36 hours. And we could circle back around to how something like that could happen. But that sort of kicked off the series of events and was really, a risk that was present due to the space's own design, a risk that lived in the space of the space's own creation. So you have that in May, And then you start to have the price spirals downward. So the crypto prices, crypto markets, you can see on this chart here, if you have the first two bubbles on the left, and then you can see that the price drops sharply in conjunction with those events. And so you have a panic, you have the collapse of Luna, and then it pushes down the value of other assets, including Bitcoin. The combination of the value of Bitcoin.
Sorry to interrupt you. I was going to say, for people that aren't familiar, the stable coin is a way to think about it, was that it's kind of like the money market of the cryptocurrency space. It's supposed to never break the buck, and it, in this case, obviously did. And that created almost a crisis of confidence in the broader sector, which led to kind of the panic selling and pushing prices down even further, right?
That's exactly right. And I note, just to linger on the stablecoin topic for a minute, the most prominent stablecoins, there's one called USDC, there's another one called Tether. They have a design that's very straightforward. If you wanted to create a token that was pegged to $1, a simple design would be, investor gives you $1, you put it in a bank account, you issue a coin, right? And then if they want the dollar back, they can redeem their coin for the dollar gets transferred back. And that is the most common design. And the most popular stablecoins follow that design. What this stablecoin was doing was saying, is there a way that we could get rid of the dollar in the bank account? Is there a way that we could do sort of a DeFi version of this, where we don't rely on putting US dollars into a bank account, but we're still pegged to the value of $1? And a lot more could be said about that experiment, but where they ended up was they created a new coin called Luna, and that coin was the collateral that went into an account, and they had 100+% collateral of Luna tied to the coin that's called UST that was pegged to the dollar. So here's the problem. The value of Luna was dependent on people thinking that the stable coin would be a good stable coin. A good stable coin meaning, keeps its peg to the dollar and liquid. So in order for it to keep its peg to the dollar, Luna, the newly invented coin, is the collateral. So Luna needs to remain valuable for the collateral to have any value backing the peg. So somebody broke the peg, confidence was lost, the value of the Luna plummeted, that further broke the peg, so more confidence was lost, and that's how it plummeted so quickly. There's a circular relationship between the collateral, whose value was predicated on the stable coin keeping the peg, and the stable coin keeping the peg was predicated on the collateral having value. A lot more could be said about the topic, but it's not the case that all stable coins are of that design. It was a novel design, but it grew in prominence to $10+ billion. Now, one other comment I'd make at this juncture is that this is indicative of a general phenomenon in the crypto space today, which is it's continued to get more and more complex. And whereas 4 years ago we could talk about the space as sort of this one space where roughly everything had the same characteristics or would have the same fate, there's starting to be more heterogeneous and idiosyncratic elements to things within the space. So, not all stablecoins today are actually the same. Luna was quite different than the others. And it's one of the reasons the space has been complicated to navigate, and it's something that we obviously help navigate on behalf of clients. We avoided Luna even when it was popular and never allowed it into our index, and in doing so, protected investors from entire capital loss over the course of that 36-hour period.
And do you think the reason that people were behind Luna was like the whole point of DeFi is get away from the dollar, get away from traditional banking? So they said, well, we want something that's pegged yet not to the dollar. So they created this other, basically another currency, if you will.
Yes.
And just like other currencies that are pegged, once the belief in it goes away, the game's over, right?
That's exactly right. So the origin of it, the idea behind it, was an interesting premise. It sounds like a startup idea or an idea for now. I mean, it's not so crazy. Could you build a DeFi version of it? But then it grew and grew and grew, and the risk grew and grew and grew. And if you ask people, immersed in the space, at least on the sort of professional side, they would say this is a huge risk that's growing. And you exactly have it right, Ken, in terms of how it played out.
And so that event was like your long-term capital management event, right there, right?
Yeah. Yeah.
The massively levered system kind of breaking and causing that first leg down.
Yeah, that's right. And actually, I might also say that something else could be compared to long term, but we'll come back to that. So that was the first leg down. So what happens is both you have sort of capital destruction of several $billion dollars, and you have the depreciation, the sell-off of other crypto assets that weren't necessarily involved with Luna, but because the space is selling off. So then what happens is in June, there's a firm called Celsius that had over 1 million accounts where people could deposit crypto, and they advertised, I think north of 8% yield on those accounts. And they're a little bit like a savings and loans. So then they take those deposits and they make loans, and they're obviously trying to earn a spread, and then they use that lending activity, that lending book that they built to pay back the interest on those deposits. But it turns out that on their balance sheet, they had not only exposure to Luna, the thing that collapsed, but they also had exposure to other things that were rapidly losing value. So they went insolvent, and their balance sheet went insolvent as a result of the circumstances that emerged. And they announced that they were freezing withdrawals. So imagine 1 million accounts, a lot of individuals. They found this firm Celsius, a Canadian pension was an equity investor in this firm. And suddenly, withdrawals are frozen. You're hearing some very concerning things. And eventually they've now gone into bankruptcy. But so that's another shoe to drop is this large crypto company. It's not a blockchain. It's not, it's just a company in the space that was not managing risk appropriately, maybe and wound up in this situation. And then later in June, you had the collapse of a hedge fund called Three Arrows. Three Arrows was reported to be one of the largest hedge funds in the space, somewhere between 10 and $15 billion. I'd have to double check those numbers. They've been around for a very long time, and suddenly stories were emerging that they were getting liquidated on margin calls, on borrow positions they had out, and the way that ended up resolving, and you can see another sort of dramatic leg down, is the industry came to realize that there was widespread exposure to Three Arrows. A lot of firms had lent money to Three Arrows, and Three Arrows in turn had also reached insolvency and was not returning those funds, which then had a cascading impact on other constituents. Just to round it out, through the course of June and into July, you then had concerns about BlockFi, which was another crypto company that had deposit accounts where you could be paid an interest, being under duress in terms of their balance sheet. They were ultimately backstopped by a firm called FTX, and similarly another one of these platforms, Voyager Digital, which ended up filing Chapter 11 bankruptcy. So the crypto credit crisis of Q2 begins with the popping of Luna UST, the resulting destruction of that capital base, as well as the drawdown of the value of Bitcoin and other things that were being used as collateral, which then precipitated the insolvency and bankruptcy of a number of platforms that had not been managing their risk appropriately, and that was further accelerated by the collapse of Three Arrows Capital, which is a pretty I don't have special information, but is a pretty high profile and closely followed story right now as people are trying to understand all of the leverage involved, and how the circumstances came to be that they had such systematic exposure within the space.
Yeah, I mean, I don't know for sure, but it seemed like their collapse, there was one weekend where it seemed like there was big deleveraging going on, forced selling on the margin calls, and that's when Bitcoin dipped down to 17,000. So it seemed like the clearing event. So once that leverage was cleared from the system, obviously other things happened in the equity markets that helped cause a broader improvement in risk asset sentiment, but that seemed to be at least like the clearing event in the crypto space, and that 17K seemed to be at least the near-term bottom, right?
That's exactly right. I mean, it couldn't have been a sort of a worse time. You think about a soft macro backdrop, right? Coming out of Q1, everything is down, and you have a lot of investors who are trying to position around that. Maybe some people are taking some liquidity out, other people are rotating, other people are wanting to see sort of where the bottom comes, or they want to get comfortable around the Fed's trajectory. And then you have essentially a ton of forced selling in crypto with not that many bids, because most people are positioned to sort of be in a wait and see in May and in June. And so that pushed prices to an incredibly low level. It's hard from the outside looking in to see something to be optimistic about here, but the truth is, from the inside looking out, there's a real amazing. I mean, nobody would have wished for these developments, but there's a real amazing circumstance that has resulted as a byproduct, which is you've had a lot of risk washed out, a lot of counterparties, a lot of leverage, some institutions that had a lot of embedded risk that's been washed out. And now you have an entry price that is not a price that's pricing progress in the space or adoption. It's a price that's a function of a lot of forced selling over the course of the last few months. And it's an entry point for investors who, were interested in crypto last year, but maybe said, I'm not ready to do it, or I don't like 60,000 as an entry point. Now you have a lower price as a result of the idiosyncratic circumstances, and you have a lot of that risk washed out. So I think it's produced a really interesting moment for investors, and you saw it sort of touch certain levels. And then in July so far, we've had a pretty strong market.
Yeah, I mean, in some ways, it's you bring up a good point, and you could draw an analogy to kind of what happened during the global financial crisis. I mean, it took out some of the over-levered players that were in the market, the Bears and the Lehmans of the world, and it created a backdrop of stricter guidelines for mortgage underwriting and less leverage at the banks and things like that. So I guess a great place to go to maybe would be kind of like, from here forward, what's your long-term view of the crypto market? There's a lot of recent talk about increased regulation with the SEC and things like that. So want to pick your brain on that.
Yeah. And just one other thing in terms of the trajectory here. Of course, we don't know exactly how things will play out, but one other thing that I think is helpful to understand for people not as focused on crypto is that, and I'm pulling up Ken, another chart here from we write a monthly letter. Our CIO writes a monthly letter to clients, and this is just a little table from that. But crypto's been around for a little while now and has 4-year cycles. Generally speaking, it's had 4-year cycles. So 3 years of a bull market, of positive returns, and then historically 1 year of drawdowns. And so 2019, 2020, 2021, we had a bull market, and 2022 we're having at the beginning of the year sort of a reasonable drawdown, and of course now after Q2 a more dramatic drawdown. But I think looking at the space over a long period of time, this is reminiscent of prior cycles. And again, is one of the reasons that some investors, though it's hard, see it as almost that 2009 moment. So anyways, wanted to share that piece of history.
No, that's really helpful. I've seen that from some other sources too, and it's not obviously not 50 years of data, but it seems that there's definitely some cyclicality to it. And, you know, like your tech stocks today, I mean, they're down so much. If you believe in the long term, not the greatest time to be selling here. If anything, you should probably be adding to things that are down 70, 80%.
Yeah, so so a conversation in May and June, I traveled across the country and we work with over 1,000 RIAs. We work with broker-dealer platforms, independent broker-dealers. So I went around in May and June in the middle of the tumult that we were just discussing to have meetings. So I was in Miami, Atlanta, Chicago, LA, did Milken in LA, was in the Bay Area, New York, Boston. And a common conversation that I think we were having and investors were having was, great, if Q1's about liquidity in the macro backdrop, Q2 is about this idiosyncratic credit crisis. With a lot of investments, people are sort of refreshing their thesis, looking under the hood and saying, there's a backdrop to this, but do we still like what we own? If you own tech stocks, do we still like those tech stocks? And the answer is for some, yes. Maybe you still like Uber, but you don't like Netflix as much anymore. And you had a thesis before, but that thesis has changed. In crypto, there's a lot of investors, I think, and our clients who've had a similar thought, which is, all right, the story about what's happening here with liquidity and prices makes sense, but how do we check in with the actual underlying premise, the fundamental proposition in the first place? The idea that there's a valuable breakthrough technology here and an ecosystem of applications and use cases that are evolving. And a reason that sometimes when you interact with people who are in the crypto space, who have a closer sort of vantage point to this, they're so sort of unfazed and optimistic is because the story underlying the price, if you set aside the prices and say what's happening with the actual underlying, the adoption, the development, everything is up and to the right. I mean, it's hard to imagine, more things going right for the space. To put just a few examples to that, let me talk about sort of adoption, and then I can talk about development. On the adoption side, in order to actually use Web3, to use a blockchain, not just invest as a financial investor or financial trader, but to use it. Of course, if you're a financial trader, you can use CME futures, you can use products like ours, you can use brokerages. But if you want to actually use the blockchain as Web3, you have to install a piece of software called a wallet. The space is hell bent on alienating everyone with jargon that's completely unnecessary. But so the new jargon here is a wallet, and a wallet is just a type of app, and you need it if you want to use an application built on this new computing platform. So looking at the number of wallets installed, the install base of wallets is almost like looking at handset install base, because that's what you need to use it. Of course, investing is a different install base, but to use it. And there, the number is up month over month, quarter over quarter, year over year, and it's somewhere between 30 and 80 million users in the install base. Now, that's not the iPhone, which has 1 billion people in the install base, but that is far from nothing. The ability to access 30 to 50 million growing month over month, quarter over quarter is quite different than the state of play in 2017, in 2018, when a lot of people looked at the space for the first time. And it's accelerating. So on the adoption side, you look at the numbers, you look at the curve, the progress relative to the thesis that got a lot of people interested in the first place, and you say, this is exactly what you want to see. You want to see adoption of all of these different use cases and things that are being built. And then on the other side of the equation, you need the developers to build those applications. And last year, the number of developers who were working on crypto projects reached its all-time high, or maybe close to that. I'd have to double check that, actually, I should say. But the number of developers committing, writing code in the space grew to over 30,000. 30,000 is an abstract number, but to contextualize that, the number of developers at Coinbase, which is obviously one of the most fully featured, developed, large corporations building software in the space, is about 5,000. So 5,000 is the army that shows up to help Coinbase build everything it's building. An army 6 times the size is voluntarily showing up to build new things in the crypto space, and that has been growing. So you see the two things you want to see in the flywheel. You see, the applications being built for the users onboarding to use the applications, which then makes it a more fertile territory for more applications to be built, and that's making a ton of progress. And there's other things we could talk about as well in terms of progress. There's obviously engagement with fintechs like Instagram integrating NFTs, or there's all sorts of things like that. But just looking underneath the hood at that level, you see unbelievable progress, and progress that's very hard, very hard to make happen if there's not actually a there. And that's part of, I think, what makes people who are close to it really, really optimistic. And then if you take that and you think about where prices are at, you can see a moment that is pretty special for investors.
And how do you feel like, you can't turn on CNBC or open even the daily news these days without, recession talk, which makes you think of another leg down in equities. Maybe we're in a bear market rally here, maybe we're not. If we see further risk off in kind of just risk assets, it seems like crypto is more correlated with the NASDAQ these days. Like, do you vision kind of another dip down, or do you think kind of maybe we've seen the worst of it? Yeah, there's going to be some beta to the broader market, but maybe not as much as you saw in this kind of big leg down that we've seen.
Yeah. Unfortunately, I don't have a satisfying answer to this. The way we think about the picture is we think that crypto has a macro factor. The Fed, rates, recession, all of those things. It's a liquid asset class, and in the same way that investment grade can get dragged around, or treasuries, and you can see that in crypto too. So it's definitely not immune to that. I think coming out of June, it had a 0.6 correlation to SPY. So it's got that going on, and that's obviously up. It's heightened, right? Correlations go to 1 when you have huge liquidity events, or trend in that direction. So it's got that exposure. We then think of there as being a sort of a crypto industry factor, and then there's an asset specific factor. And so it depends on if those three are showing red, yellow, or green. If macro looks red, but you have a lot of strength in the industry and on specific assets, then you could see a scenario where there's a strong decoupling and divergence. And indeed, we've seen more of that happening coming out of June. But the devil will be in the details. So we sort of talk about that picture. There's some things to really have an eye on. I think I think professional investors watching your show, have their heads around the macro picture and can kind of imagine what to be looking at there. A little bit harder with crypto to know, okay, great. You think about these three factors. What should I have my eye on with the crypto industry and with asset specific? So I could share some thoughts on some things to be watching on that front if it's interesting.
Sure. Yeah, would be great.
Yeah, I think so. I think on crypto industry, obviously the trajectory of the contagion and credit crisis has been important. I think that has now flipped from a deep red to trending through yellow, where we may be through. This is my perception that the official view of Bitwise will be in the CIO's monthly letter. So that's the final word on it from Bitwise, but is trending in the right direction, and is going to flip from a lot of pain and destruction to what you're hearing now is, wow, this is incredible. The industry was durable through a credit crisis with no backstop from the Fed, and now we've washed out a lot of that risk. The industry is the wiser for it. Investors are now increasing collateral ratios. They're increasing their diligence on counterparties. They're being more thoughtful about who they're doing business with. So you actually get a more durable ecosystem and market structure as a result of that. So that's flipping from red through yellow, maybe into light green. And then the other thing on that front that is I think in focus for a lot of people is the regulatory story, which is sort of always on people's minds from the crypto industry perspective. And there's some pretty interesting things, in terms of if there are things I'd suggest people keep an eye on. That's another one. Ken, when I started Bitwise approximately 100 years ago, in 2017, just to paint a picture of the journey of the space, when we started, I raised $4 million of equity capital to get the firm going from institutional investors. And they wanted to wire those funds to the company's bank account. I couldn't get a bank account because no bank in America would allow a business banking account for somebody doing the dirty work of crypto. I'm not saying that I wanted to put Bitcoin in a bank account or I wanted to purchase. This is just a Delaware C Corp that has, sold equity through a Reg D, private offering to institutional investors, QPs, and banks wouldn't give us a bank account. There was one bank that banked almost the entire industry at that time, down in La Jolla, California. So I just like to say that because the current state of play in crypto just couldn't be more different, and was hard to imagine from that vantage point looking forward. But when we started, there was a real question about, okay, this is a kernel of something interesting, small. Is it an asset class? Is it a project? What is it? Some people think it's interesting and relevant. Will it ever amount to anything? One day, will the big financial institutions wake up, and what will they do about it? What will the fintechs? What will the big tech companies do about it? Et cetera, et cetera. And another question is, what will the regulators and lawmakers do about it? And we now are at the part of the journey where there's a lot of visibility into that. And even just in 2022, the amount of visibility has dialed up substantially. So some of the important events this year, the White House put out an executive order. People may or may not have seen this. I think it's back in March, maybe April, basically saying that the regulatory agencies need to produce plans that will foster innovation of the digital asset space onshore in America, will provide investor protections, but will allow this space to grow and advance and to the benefit of Americans and the American economy. That's a huge card to turn over that a lot of investors had no idea how the White House would take a view on the space. And for them to have that productive balance, everyone wants investor protection. Also, to be clear, maybe certain constituents in crypto don't, but most like us do. Most of our clients do. So that was a very productive view to come out of the White House. And then in July, we got two things. We got the framework for international engagement on digital, something from the Treasury. I can't remember quite the name, but a productive framework for how they will think about fostering those wishes of the executive order. And then you got something from lawmakers. In July, the Loomis Gillibrand Responsible Financial Innovation Act. This is a draft bill that proposed to fill in some of the blanks, fill in some of the gaps where you hear people say there's a lot of gray area in crypto, or we don't know, crypto's not clearly regulated, which is a real challenge for the space. That feeling exists. I sometimes like to use the analogy that crypto today is sometimes feels like if you went to the grocery store and you went to the dairy aisle to buy milk, and none of the milk had been reviewed by the FDA. There were no labels. And so you're like, okay, some of this milk could make me sick. If I brought this home and gave it to my family, it makes some of my family members sick. So you're Googling what does spoiled milk look like, and what is the color of, and you're in the grocery store trying to scientifically detect indicators of and so I think for a lot of investors, crypto kind of feels that way today, which is the burden of figuring out. They know that they can navigate this space successfully and they can find the milk that's safe to drink, but the burden is so high and onerous. And obviously nobody wants to bring spoiled milk back to the family and be responsible for giving that to people. So a huge unlock to bring this back around. We talk about the crypto industry factor. There's what's going on with the market structure, which we talked about. But a second one is this would be one of the biggest possible unlocks for this space, is to finally go from sort of the good luck figuring out the milk for yourself to there are some labels on these things. And of course, investors will always have to make their own decisions, but some clarity around, okay, what are the disclosures I should be looking for? What are the, how do I know that I have a really good shot at getting what I want? So we're seeing that that thread playing out now. People wondered about it for half a decade. 2016 they wondered, 2017 they wondered, 2018 and 2022 it's actually playing out, and it's on a positive trajectory. And I just want to sort of end the point by saying, when I say positive trajectory, I don't mean that everyone in crypto is going to get to do whatever they want. That's not what I want. That's not what investors want. Like, positive regulation doesn't mean yes to everything. Positive regulation means clarity about where the lines are, and reasonable lines so that we can all productively focus on that area. And I think that that's coming near term. So I think that'll be a huge step forward on the crypto factor. And
I think that's a really interesting point, because like the immediate reaction of people when they hear about like Gensler and SEC, they're like, oh, this is bearish for crypto because they're going to get regulated, right? Whereas another way to think about it is the regulation actually can create an environment which allows more adoption and more capital to become comfortable with the space. So in a way, it could be bullish, right?
Huge. It's the single most bullish catalyst that could possibly take place for the space is a productive and very clear and widely understood regulatory regime. Now, the thing that people worry about is, what if Gensler says the dairy aisle is closed? There will be no milk, cheese, and sort of throws out the baby with the bathwater. That would be the sort of extreme version of the concern, but that's not such a likely scenario. But so people are pushing, they want a productive version. And that's wise. And this is the dialogue we should be having, and regulators should be forced on making sure that investor protections aren't compromised. And then, there's a lot of constituents who are saying, well, innovation and GDP growth and being a global leader in a fast growing new technology category also shouldn't be compromised. And a lot of Congress people have a big viewpoint around that. And the other thing I'd say on the Congress front that's fascinating in 2022 is Coinbase is 100 million users. So the constituents of each representative, by and large, has an interest in crypto being productively cultivated, and so it's been very interesting to play out. Now, I'd argue that a lot of those individuals would do better if their advisor was helping them navigate some of this craziness. I do think that some can, but for many, it's just you're sort of outmatched by the complexity. But anyway, so that's a factor that I would keep an eye on. The market structure. Just to give one more example of things that we think of in this factor, I think it was last year that China made Bitcoin mining illegal, and you put illegal China and Bitcoin into a headline, and it's a recipe for something that looks pretty gnarly. But that would be another example of a big step forward on the crypto market structure and industry factor. A vulnerability of the space was that there was so much dependency on compute on data centers in China, which was a real concern and risk and vulnerability. And so in a way, there's sort of the action wasn't taken by China for this reason, but I think for most Western investors, it was a huge positive that got de-risked, and that today all the data centers are outside of China, even though they weren't doing it to benefit so those would be factors there. And then on asset specific, the biggest one that I'd be remiss for not saying as sort of the crypto guest joining your show is that people should be attentive to what's taking place with Ethereum in the second half of this year. And that's an asset specific story. Ethereum, the software for Ethereum is getting upgraded. So you could think about this as, on your iPhone, you get those annoying alerts that there's some new operating system that it's going to download while you're sleeping. So similarly, there's an upgrade coming to Ethereum. It's not exactly the same, but that type of thing. And the upgrade is a really big deal. It carries with it 3 properties that are important. One property is it will take the energy consumption and thus the environmental impact of the processing of the compute of this network. It'll take it down 99%.
Wow.
So when you think about something like Bitcoin and Ethereum and the general backdrop of rising consideration for ESG and for the environmental footprint of different business activities, you're actually going to go from Ethereum and Bitcoin looking similar to them actually being quite differentiated on this dynamic. So that's an important asset-specific story that could be quite bullish. I think everyone in the space sees it as a really bullish. I color that green, and the two other changes that come with that will be the issuance, the supply curve will become capped and deflationary. So there'll be less and less Ethereum in circulation. And then finally, there will be yield on Ethereum. So Ethereum will have an ability to do a thing called staking that almost like a CD. You take your liquidity and you get a yield as a byproduct of that. We could go way more into that. But anyways, that's referred to as the merge, and that is scheduled to happen late September. Could go into October. But it'll be a huge moment for the space, and so that's an asset-specific story that I think is good to keep an eye on in terms of how I guide people to, again, they can follow the macro factor, but to think about those other two factors.
Yeah, and Ethereum's had a pretty good run in the last like 30 days, right? I mean, same with Bitcoin, but Ethereum seems to be leading the way here.
I don't have the latest, but I think it might be up over 50% over the last 30 days as that factor has sort of come into focus. And there was a development this summer that upgrade had been delayed many times, and then there was a test this summer where it finally looked like it was going to happen. We wrote a letter, I think, in maybe 2 months ago about covering this topic. So crypto these days, there's a lot. I sometimes like to say it's like a rainforest. There's all this stuff in here. There's some things that'll kill you. You walk into the rainforest, there's some poisonous stuff. There's just some funny stuff you've never seen before. And then there's some things with useful properties. And we try to spend our days with 75 people, tech backgrounds, asset management backgrounds in the rainforest, trying to separate the dangerous from the worthwhile. We're not perfect at it. We have avoided things like the Luna collapse, and we try to bring focus to the things that are worth the limited time and attention that people have. But it's an ever expanding set of things to keep an eye on. So if this conversation feels that way to your viewers, I just want to rest assured that it is a lot. And the other thing I would say is that it's not an investor's job to follow this any more than it's their job to follow everything that's happening in the private credit markets or in the MBS markets. It's their job to find professionals who can navigate that for them full time, and that's the role that we play in the crypto space.
Yeah, or find diversified passive vehicles to get beta exposure to. So on that note, asset allocation. You guys provide a couple different vehicles. One, like just simplify things. You can get just exposure to the coins, right? And that's what I think when most people think about when they think about crypto is like, okay, I want to be long these coins in case all of a sudden they take off again, and I can make money on the recovery of the coins. Then there's the companies that are trafficking in the space using the technology, right? And that's more of just equity exposure. You can think about it as maybe like small cap growth exposure, and it's gotten killed recently. So the prices are attractive. You could argue. So how would you think about asset allocation for those two things? They're very different, right? I would say that I would think about the exposure to the crypto companies as more like think about that as within my equity exposure, within my kind of small cap or mid cap growth exposure, and then the coins obviously a little bit more volatile, riskier. Perhaps not. Who knows? Only time will tell. And what do you think the right allocations are for investors on those things?
I don't know the right allocation. What we see across investors, and we try to for every investor, it's sort of a different thing depending on their objectives and their asset allocation, how they're doing portfolio construction, and what they already have going on. We tend to see 50 to 300 basis points. You can look at impact on max drawdown and Sharpe ratio, and you sort of see the most bang for your buck in that range. And I think also a simple thing that many investors sort of can imagine is, in the worst case scenario, I'm wrong, the whole industry's wrong, the investors are wrong, and the thing plummets 70%, and you put 100 basis points in, you lose 70 basis points of performance that year, because it all goes as bad as possible. So I think that that's an element why we tend to see people around that size, but 50 to 300. Some, of course, go 5 or 10. Aside from certain, very wealthy families, we don't often see north of 10. And sometimes another thing we'll see advisors will sometimes start with a few clients that are the most interested clients before working it into their whole their models or the rest of their book. But that's sort of, and then to your point about, would I rather invest in the companies, the picks and shovels, or would I rather invest in the coins? And we see split tickets. We see some people say, I'm just more comfortable on the equity side. These are publicly listed companies in the US with financial reporting. They have cash flows. Interestingly, Ken, especially in this environment, they're also profitable. So a distinction between them, and we have a good white paper on this, but a distinction between them and typical tech growth, or small cap tech growth is they have very appealing growth forecasts, but they also have profitability.
Crazy concept, profitability for a tech company, right?
Yeah, it is. It's a little unfamiliar. So some people like that, and they say, this is a good way to play the space for me. And again, or on the other side, some people say, I want to be close to the metal. I want to directly have exposure to things like Bitcoin and Ethereum and Solana and others. So there we see, I think in the first half of this year, we saw sort of equal allocation, or maybe a little bit more to the coins, amongst advisors. And then I'd say a third bucket is there's some investors who have very specific theses. So we see a range of different approaches. And I don't know that there's any one sort of emerging as the most common way. I think that the trend that's emerging is, maybe over the last 2 years, there was more, I think that this category is here to stay. I don't know how it's all going to play out. I'm just going to buy some Bitcoin because I don't know about all this stuff. And I think people are now moving away from that and realizing the heterogeneity that, buying some Bitcoin, it's like buying AOL to play the internet. It's part of the space, but you're, it's not, in a world where Bitcoin is the only thing that's valuable that works out, that will have been a smart bet. But there are many other versions of the future where you would want to have participated in a broader set of things. So I think that is one consistent trend, is just the move into a broader set of assets. But that's what we see.
Awesome. Well, thanks again for your time. This was really interesting, really entertaining. I think our viewers will find it very helpful in just, kind of hearing about the market from someone that's deep into it, as opposed to just the panic on CNBC when prices are falling. And on my last episode, I did kind of a mid-year review of markets, and the comment I made about Bitcoin was, I don't know if it can get any worse than when I open up my Bloomberg and I see the headline being the death of Bitcoin, usually, or the death of crypto, right? It wasn't even crypto winner, it was like the death. And when you see those type of headlines, it's kind of like at the top of the market, I feel like you'll see not even the Fed can keep the equity market down, right? That's going to be the type of things you see. But in market bottoms, usually you get those type of headlines on Barron's and economists and things like that. So you got me more bulled up on crypto. Thanks for the insight, and I hope maybe we'll see each other. I know we're in California, but maybe we'll see each other in person one day. Maybe it'll have to be in New York.
Absolutely. Yeah, this is great. This is a great conversation. So I really appreciate it.
All right, thanks. Have a great summer.